Ladies and gentlemen, good day, and welcome to the Q3 FY26 earnings conference call of Yasho Industries Limited, hosted by MUFG Intime. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nikunj Sheth from MUFG Intime. Thank you, and over to you, sir.
Thank you, Swapnali. Welcome to Yasho Industries Q3 FY26 earnings conference call. From the management today, we have Mr. Parag Javeri, Managing Director and CEO, and Mr. Chirag Shah, CFO. Before we proceed to the call, I would like to give a small disclaimer that the call may contain certain forward-looking statements which are based on business operations and expectations of the company as on today. A detailed disclaimer has been given in the company's investor presentation, which was uploaded on the stock exchange. Now, I would request Parag to give his opening remarks. Over to you, sir.
Good afternoon, everyone. Thank you for joining the Yasho Industries Q3 and Q4 FY26 earnings conference call. We appreciate your continued support and engagement. I hope you must have had the opportunity to review our results and the investor presentation shared earlier. The third quarter marked a period of steady and a broad-based improvement for the company, supported by healthier demand conditions, stronger volume traction. For the 9-month period, revenue stood at 583.76 crore rupees, reflecting 19% year-on-year growth, despite an environment of continued pricing volatility across certain products categories. Across global market, customer sentiment is gradually improving, although some regions continue to experience macroeconomic challenges and industry-wide headwinds. Even in this backdrop, demand for our key product group has remained stable, which is evident in strengthening volume momentum witnessed during the quarter. In Europe, the evolving India-EU trade environment has supported improved engagement across multiple end-use industries. Our European subsidiary now benefits from strong demand visibility for the coming year, positioning us for accelerated growth and deeper penetration in this strategic region. Operationally, while our Pakhajan facility continued to operate below optimal utilization, the impact on margin was effectively contained. This was achieved through a combination of product mix refinement, improved throughput efficiency, and disciplined cost control initiatives. As a result, we delivered an EBITDA margin of 17.06% for the 9-month period. Our Pakhajan R&D center continue to strengthen our innovation pipeline through customer-specific developments, application trials, and a new chemistry, positioning us to scale, differentiate, and value-accretive chemistry in the year ahead. On the growth investment front, our strategic manufacturing project with large MNC is progressing as planned. The estimate cost of the project is approximately 85 to 90 crore, which will be fully funded by customer. And we have already received an advance of rupees 19.9 crore. Equipment deliveries are expected to begin in Q2 FY27, with commercialization target for Q1 FY28. In parallel, as part of our capacity enhancement initiative, we have deployed rupees 25.9 crore toward two manufacturing lines focused on high visibility product categories with sustained demand. Trial runs for these lines are expected to begin in March 26, and commercial production is planned for Q1 FY27. Looking ahead, our long-term strategy continue to gain momentum. With the commissioning of our two new lines and execution of LPSL project, we expect scale of our revenue in FY28 to approximately rupees 1,500 crore at around 40% utilization of available space at Pakhajan facility. The facility infrastructure is already equipped to support 15 to 25% annual growth over the long term, and we expect a 4 to 1 revenue to capex ratio for incremental investments. FY26 and FY27, we remain confident of sustaining our growth trajectory, supported by strong volume momentum, improving domestic demand, greater geographic diversification, and stable improving margin. A sharp focus on cash flow generation, working capital discipline, and operational excellence will remain central to our execution. Despite ongoing global uncertainty, we believe Yasho Industries is well positioned to build a stronger and more resilient platform for growth as we move into FY27 and beyond. Now, I invite our CFO, Mr. Chirag Shah, to take you through the detailed financial update.
Good afternoon, everyone. I will take you through the key financial highlights for the quarter and 9 months ended FY26. Revenue for the quarter stood at 201.83 crores, reflecting a 35% growth year-on-year. The improvement in profitability continued as well, with the quarter delivering an EBITDA margin of 16.65%, driven by sourcing efficiencies, operational discipline, and improved plant level productivity. Cash flow optimization remained a key priority this quarter. We continued tightening inventory practices, enhancing receivable collections, and synchronizing production cycles with order visibility. These measures are progressing well and have supported a gradual reduction in working capital intensity. As we move into Q4, we anticipate further improvement in the working capital days. On the balance sheet front, our gross debt levels are expected to stabilize in the coming quarter. Reducing leverage continues to be the central financial priority, and we remain focused on lowering our debt to EBITDA multiple through improved profitability, controlled capex deployment, and strong cash generation from operations. With healthier demand visibility, improving margin resilience, and ongoing focus on cash flows and balance sheet strength, we believe our company is well positioned to deliver consistent, profitable growth over the coming quarters. Thank you, and we now welcome your questions.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. We have the first question from the line of Parth Agarwal from Bastion Research. Please go ahead.
Hi. Thank you for the opportunity. I have just 2-3 questions. So one is, can you just help me understand the reason for gross margin compression if I look at sequentially or on a YOY basis? Is it related to because of the tariff we have taken from price tariff hit on our books, or is there something else to it?
Well, this is purely due to the change in the product mix. Also, we went into the diversified market geographically. So that is change for last quarter, little dip in the profit margin.
So this quarter, we have strategically sold low-margin products. Is that understanding correct?
Yes.
And why is that?
Well, that depends on the customer demand.
Okay, got it. Okay. Secondly, so considering now the, tariff has been reduced to 18-19% now in the U.S., so are you seeing an uptake in inquiries for this month and this quarter?
Well, we started seeing a discussion, but it will take a while to convert into the reality, because yet it has not been notified. Only the 25% has been notified of, but the balance 25% is not yet back to 18% so far. People may like to wait and watch.
Got it. And also, we had some inventory backlog last quarter. So I'm assuming it's yet to be cleared out.
We see that the quantum is moving quite well. Okay. We know that the sum of inventory has built up because purely we have to operate the plant at certain efficiency. And looking at the visibility of the future order, we have built up the stock.
Got it. Just a last question from my side. So in your presentation, you mentioned around, you're working with some other, MNC customers with large revenue potential. So can you just highlight something more like some opportunity size or molecule or anything else that you can give around this?
No, I don't think so, because as per our NDA, we are not supposed to disclose much more information on the matter unless until we start the commercial production. So I'm sorry for that. I cannot give you more insight.
Sure. Okay.
Thank you.
Thank you so much, and best of luck for the future quarters.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. We'll take the next question from the line of Manish Gupta from Solidarity. Please go ahead.
Thank you for the opportunity. Parag bhai, I just wanted to check, in your presentation, you had mentioned that by FY28 now we have capacity for a revenue potential of 1,500 crores. In your opening statement, did you mention a revenue guidance of 1,500 crore by FY28, or was that capacity guidance?
Well, that is the potential by FY28 with the kind of debottlenecking, whatever we did, and so that is what we expect by FY28 we should achieve that revenue.
Parag bhai, isn't that a very aggressive guidance? I'm saying, let's assume we end this year about whatever 800, 850, for the full year. 850 going to 1,500 crores, despite a tough environment, it's like you're really sticking your neck out over here, right? I mean,
I know it is a challenging, but there are two factors, Manish bhai. Number one, company will have a grow with its existing capacity, which we could not achieve the full utilization in FY26, what we anticipated. We expect that to happen in FY27, plus in FY28, we will have this long-term supply agreement revenue kicking in. So looking at the combined growth of that, that's what we are expecting, a potential of 1,500 crore. We are not saying that we will achieve, but there is a potential to achieve that with the existing investment in a capex.
And this 1,500 crores, can one assume a blended margin of about 18% on this as peak potential?
At least, yeah, we do. See, my guidance will be still going to be between 17 to 19%. We are able to maintain on and above 17% as of today, and we hope with the improved utilization of the plant, we will be able to achieve 1.5% additional margin.
Okay. And Parag bhai, given that the US tariff was fairly out of the blue, and we've got a president who might again change his mind, how are you de-risking the business from any random action by somebody, so that we don't have so much of impact on the business? Can you talk a little bit about what actions the company is taking on that front?
Absolutely. That's a very good and valid question to understand the strategy. So what we have done is the number of measures we have done. We are looking at a different geography where Yasho has never looked at it. South America, the Africa region, also in Asian market we are not so gung-ho where we are, which is very close to the another Asian giant, so we were a little bit reluctant. Now we are moving into all this market, and somewhere there we do not have the same margin as much as what we gain into the North America margin. So we are diversifying our market in a different zone. Number two, we are turning our product mix as what we can sell in this new market, new potential market. That is what helping us. And number three, thanks to our strong R&D, we are still further streamlining the process, and as the plant is getting up more efficient, we are able to do the cost saving on a number of fronts. So with the three approach, we feel and we strongly believe that we will be able to overcome this current crisis of FY26, and FY27 will be robust for Yasho.
Can I ask a few more questions, or are there my other colleagues might be on the line?
Maybe one more, and then you can come back to line.
Okay, sure, yes. Sure. So, can you talk about the incremental R&D investments that we are doing, Parag bhai? Are these principally in existing areas, rubber and lube, or are these in some other industrial chemicals? And I think the broader question is what's the framework you are using to decide which product categories you are focusing on in R&D?
That's something difficult, but I can give a straight answer that we are looking for a molecule which can at least generate 25 crores revenue a year, at least, or more. Number one. Number two, we are looking for a chemistry application beyond rubber and lubricant also. So that's how we see that our specialty segment, the performance chemical segment, is growing at a healthy speed. Also, though, we have a lot of customers coming on to us for a special chemistry to develop for them. So R&D is working on a multiple projects on something similar chemistry, something different chemistry, something altogether different which Yasho has never ventured into it.
Okay, I'll come back to you, Parag bhai. Thank you.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. We have the next question from the line of Naeem Patel from Bastion Research. Please go ahead.
Hi, thank you for this opportunity. I just wanted a quick question on impact of tariffs on our revenue. The 50% reciprocal tariffs are still in Q2, and if those tariffs were not in the present, they were normalized like our current situation, what would have been our sales in Q3?
Sorry, I didn't get your question.
Sorry. So if in the current quarter, in Q3, if there were no tariffs, no heavy tariffs which we had this quarter, how much impact on that sales would it have been?
Well, there would have potential sales if the tariff would not be there. Also, the margin could have been better, but I say basically this well, the tariff has helped us to look beyond comfort market. Comfort, when I say that the language point of view, the accessible point of view, that is helping us to diversify our portfolio. So we are happy. And with now tariff almost on the way out, we expect reasonable growth back with our market. In Yasho, the US market share was more than 30-35% to regain that.
Understood. And just to follow up on that, how much revenue from US did we have in Q3 FY26?
It's about roughly about, I don't have from USA, but I have from the Americas because I don't, so that is about 20-22%.
Understood. Thank you. That's all from my side and best of luck.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. We have the next follow-up question from the line of Manish Gupta from Solidarity. Please go ahead.
Parag bhai, if you had 22% revenue from the US in Q3, can you share
Americas, not US.
Yeah. So, I mean, whatever the number was from the US, I'm not fussed with that percentage number. What I wanted to understand is that if you had X crore of sales from the US in Q3, was the burden of the tariff shared between you and the buyer, or you absorbed it, or the buyer absorbed it? How did that work?
Okay, so a lot of product of Yasho had an exemption on the tariff. So USA custom has not put a price across the blanket, across the board, but they have a lot of exempted products. And the business revenue what we have currently from the product where it has been exempted. But wherever there is a 50% tariff, we have a very small business.
Okay. So, just so that I'm clear, where there was tariff, you had very small business in the quarter, or a product range was such that it was already exempted from tariff and therefore the tariff did not have any impact?
Well, the lot of product where there is a tariff of 50%, we have a very limited business. And where the product on which there was no tariff, we had a business continuation.
Okay. And, like this contract that you signed with this particular MNC, are you in discussions with other MNCs for such agreements?
We are in discussion with multiple customers. So this customer has been discussed because of the material involved. We were supposed to get the money from them to build up the plant, so that will be disclosed. Otherwise, we don't have policy to disclose about our ongoing business. But let me assure you, we are working with all major players in the field, in rubber and lubricant.
Okay. Okay. That was useful.
Yeah.
Thank
Hello. Yeah.
Thank you, sir. We have the next question from the line of Poojan Shah from Molecule Ventures. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, first question pertains to just want to understand the dynamics right now. So, there was a tariff impact and the customer might have waited all along to clear all this first. But in that scenario, do you have seen any certain company which have started aggressively building the capacity, assuming that tariff will remain, and ultimately there is a high scenario or a probability of getting dumping even the countries have higher tariffs? So do you have seen any such type of conditions out there, or it is not happening?
No, we are not seeing that so far.
Okay. Got it, sir. Got it. And sir, just wanted to understand if you can spell out right now the capacity utilization of Pakhajan, because if we consider a growth of from 800 crores to 1,500 crores, assuming that
that is 1,500 crores will be happening in next 2 years' time, not in 1 year time.
Yeah. I understand that 100%. But obviously, utilization will also take time in certain things. So so right now, what we are seeing is that 40% utilization out there, 40 to 45% in Pakhajan?
Yeah, because of the since Q2, Pakhajan has dropped below 50%.
Okay. Got it, sir. Got it. And after all this, government has already, well, obviously, the tariff has been now almost been done. So just wanted to understand, are we seeing the opportunities, the similar opportunities, considering the 150 crores of OMC? Are we seeing any RFQs coming up with different companies altogether just to build the similar line of things or altogether new product ultimately with us?
Absolutely. And that is what giving us the confidence that in the next 2 years we could achieve this number.
Got it, sir. Sir, just wanted to, last question would be, any plans on to reduce our long-term or short-term debt? Any concrete plans in next 2 years?
No, but we will be bringing down the debt to EBITDA ratio. That I can assure you.
Yeah.
But I'm not in a favor of reducing the overall debt. Overall debt we will reduce in terms of long term, short term may increases, but it won't increase from here. That's what we're trying to say.
Got it, sir. Thank you so much. I will join. Thank
you.
Thank you. We have the next question from the line of Harshil Bayani, an individual investor. Please go ahead.
Hello, can you hear me?
Yes.
Yeah. Hi. Thank you, Parag sir, for the opportunity. So my question is, in this for the 9 months, what would be our days of inventory?
Right now it's about 200 total. Okay, no, that is working capital. Days of inventory, about 170 total.
170.
Raw material, finished goods and work in process.
Okay, got it. And sir, next question is, hello?
Yes. Hello.
Harshil, please proceed with your question.
Yeah, actually, I forgot. I'll get in the queue, sir.
Thank you. We have the next question from the line of Jay from Star Investment. Please go ahead.
Hi, sir. So what is the optimal production capacity planned for the Pakhajan plant? What peak revenue contribution do you expect once that capacity is fully utilized? And by what timeline do you anticipate reaching this optimal level of operations?
We are expecting optimal level utilization of 80-85% by FY28. And the revenue should be in the range of about 750 to 850 crores, depending on the market condition.
Okay. And my second question, like with the India-EU free trade agreement now signed and our European subsidiary established, what level of demand visibility can we expect for the next fiscal year, and which geographies should we prioritize for sales expansion to maximize the growth opportunities?
See, the number one, Europe should be definitely benefited to us because under the treaty, what we realized that the chemical has been got down to 0%, but we have to wait and watch when that happens. So, and also for Europe, we have our 2 sales people based in Europe are reaching out to customers. They come on board in last 6 months on Yasho board. So we are very encouraged, and the kind of a customer response we are getting now from the market is very positive. So we are hopeful. Number 2, we are also expanding into the South America, that's Americas, part of Americas and Africa market. That's our diversification point of view. We have a good green road into the Americas market like Central America, South America, while Africa, it's just beginning. Let's see how far we can grow.
Okay, thank you, sir. I'll join queue if I will have further
Thank
questions.
you.
Thank you. We have the next follow-up question from the line of Parth Agarwal from Bastion Research. Please go ahead.
Hi. Hi, thank you for the opportunity again. I have just one more question around the, competitive intensity in the lube additive market. So as per my research, it suggests that, Richpool, there's a Chinese competitor who is, basically expanding massively, in this space. Are you seeing any kind of, pricing disruption because of that? Because their capacity is expected to go live in FY 27 as well.
Well, we know them. We know what competitors are coming up, and we know the pros and cons of that, those competition arising from other Asian countries. And we are well prepared for that. I can say that much. Cannot divulge much more information.
So we are not expecting any negative implication because of that on our product portfolio.
It will be tough competition. I can say that much.
Okay, got it. Thank you so much.
Thank you.
Thank you. A reminder to all the participants, you may press star and one to ask a question. We have the next follow-up question from the line of Harshil Bayani, an individual investor. Please go ahead.
Yeah, thank you for the opportunity. My second question is, sir, what is our capex for these 9 months and the capex plan for next 2 years, excluding the Europe MNC capex?
Well, this year we had done a capex of about 60 crores, 25 crores in 2 lines where we saw the demand coming, and another 25 crores we spent in R&D. So that's about 55-60 crores. Balance we have deferred our capex, even though we had a plan looking at the current condition. If we see that the things are getting improvised, we will definitely go ahead with that balance capex what we have not done for FY 26 and go ahead in FY 27.
Okay, thank you. And sir, what is our current borrowings, excluding the promoter loan?
I think it's about 560 crores something.
560?
Yeah.
This is excluding the promoter loan or including promoter loan?
With promoter loan.
With and what is the outside loan?
Outside that is bank loan. Okay, bank loans are about 500 crores and balance 50 crores is come from the promoters.
Okay, sir. Okay. Yeah. Thank you.
Thank you.
Thank you. We have the next question from the line of Aditya from Securities Investment Management. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, this contract which we won from the MNC customer, so just wanted to get a sense, is it common in this industry where the customer funds the capex? Because generally I understand these kind of deals generally happen in the case of a pharma segment where there are new molecules where the customer would like to fund the capex. So is this capex being done for a new kind of additive, or these are older products only and the customer just wants stable supply? Just some sense if you could provide what helped us win this contract.
I don't know much on that, what is the customer mindset, but I can say this is very unique molecule, has a unique process. So and we had a capability to manage that kind of thing. So that's why customer has chosen Yasho as a partner, long-term partner.
So is this a new kind of an additive, or these are older additives which are common in the market?
Thank you. I can't give much more light on it. So, hello.
Aditya, does that answer your question?
I cannot give more insight on this molecule.
So my next question was, if I look at domestic market, for the last 2 quarters, we have seen very strong growth. If you could just help us understand what is leading to this growth?
Well, as I said, we are identifying a lot of new markets that is growing. Also in India, we are able to continue our growth, particularly in Q3. We could increase our reach out to the customer much more with our aggressive strategy of pricing. And demand in India, we've seen it's been improving day by day. Not only in industrial, but also somewhat into the consumer segment too. That is helping us to continue the growth in volume.
Understood. And just wanted to get a sense. So is it majorly led by lubricants or rubber additive? Just some sense if you could provide.
Both.
Okay,
Yeah,
understood, sir.
Yeah, thank you.
Yeah.
Thank you. We have the next question from the line of Preeti Agrawal from SK Associates. Please go ahead.
Yes, thanks so much for the opportunity. I wanted to know that given our increasing strategic emphasis on the industrial segment, could you provide clarity on what percentage of total sales you expect in this segment to contribute over the next 2 to 3 years?
Yeah, right now we are about 85 to 90% industrial, will eventually go to 90 to 95% in next 2 years' time. That's what we expect, because consumer will remain flat or will have a degrowth, further degrowth.
Understood, sir. Thank you so much.
Thank you.
Thank you. We have the next follow-up question from the line of Manish Gupta from Solidarity. Please go ahead.
Parag bhai, another clarification. If I exclude the consumer segment, so my question is just on the industrials, would the gross margin change, can that be explained completely by product mix change, or did you also have to do some discounting to push volume from the new plant?
Well, it's more from a product mix, and I will say 80% from product mix and 20% from discount.
Okay.
If there's a bulk buyer.
And so when you say is bulk buying, then it's really a volume linked discount.
Yes.
Okay, great. Second question is, Parag bhai, you offered a guidance of roughly 1,500 crores by FY28. Would you be able to split that? I guess you're close to the end of the year. How much you'll finish this year by approximately? Even broad range is okay.
We'll do somewhere, this year should close somewhere about 800 CR.
And next year would be how much roughly then?
We are in process of doing budgeting, Manish bhai, and I think I will have a more clarity from my global team as well as my local team in the next couple of weeks.
So the FY28 1,500 crore is really an aspiration, right? It's really not a guidance, right? It's really what you would like to do or you have full capacity to do. It's not a number that...
I can say, Manish bhai, that's the potential to achieve with 80% utilization of the Yasho capacity.
Okay. Yeah.
Thank you.
Thank you.
Thank you. We have the next question from the line of Manjeet Buria from Samya Advisors. Please go ahead.
Parag bhai, thank you for taking my question. Just one there. 2 years out or whenever our Pakhajan reaches optimal utilization, what is your expectation between the mix of spot market versus sales via long-term contracts to some large customers globally? Like your expectation whenever we are at full utilization?
Well, we will be aspiring to have a long-term contract to fill this kind of capacity, and we are working on that. So that's where the confidence.
Sir, I meant would majority of our sales at that point be long-term contracts when we reach full utilization, or will be a meaningful part from spot market?
It will be a 60 to 70% long-term contract, 30% will be spot.
Okay. Thank you, sir. That was my question.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. A reminder to all the participants, you may press star and 1 to ask a question. Thank you very much. As there are no further questions from the participants, that concludes the question and answer session. I now hand the conference back to the management for closing comments. Thank you, and over to you, sir.
Thank you, everyone, joining for this conference call. Have a good day. Bye.
Thank you, members of the management. On behalf of Yasho Industries Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.